What's up everyone, this is Warren Howe. Hope you're having a great day as always. Now in this video, I want to address the market outlook, calm things down, what is our personal strategies moving forward, and just be reminding that fundamentals matter. Yep. So if you haven't, appreciate it if you guys can subscribe to our channel. Yep. Drop that like in this video if you liked it, enjoyed it, if it provided value. So let's begin. Now we are in bear market territory, okay? The Nasdaq is dropping 20% from the highs right now, and it's bad. The situation is bad, yep? It's caused by four whammies, yep? Inflation, prices going up, right? Prices going up caused by supply chain backlogs, supply chain disruptions, shutting down factories, okay? And then paired with commodity prices, which is the core reason, yep? Energy, steel, silicon metal prices going up, all these crazy things, yeah, which in turns have a ripple effect of from the upstream, affecting all the way to the downstream companies, affecting their bottom lines. Yeah, we have interest rates going up, which will make stocks less attractive, simply because interest rates are going up. Their money elsewhere is could be on a safer asset. Yeah. But we all know that when inflation goes up, the way to combat that is by investing. Because as long as we invest in what we know, which is something I'll be talking about a little later, and obviously the fourth thing is the Russia v Ukraine crisis. Yep. So the Russia v Ukraine crisis, sorry for the people in Ukraine. Yep. Hopefully you guys get better and much love. Those are things that we can't control. What we can control, as mentioned in the previous video, is our portfolio management. How do we invest? How do we capitalize on assets? How do we protect our portfolio drawdowns? Yep, and such. But the majority reason, in my opinion, is that the Russia v Ukraine case is sparking huge fears, right? If you would ask me, market fears, it is insane levels. It's probably not maxed out yet, especially with the bear market. There's more room to go down because that sort of breaks the trend. But we have to understand, we were in a huge bull run 12 to 13 years ago. Now cycles happen, sectors, we should be talking about a little later, right? Sector rotation. But when markets actually fear, yeah, how does that impact the fundamentals of the companies that we are investing in? Yeah, so Russia v Ukraine plus inflation is the reason why the Nasdaq is actually going down. The S&P 500 could go down 20%, but we should be ready for it. Right? We should be going in tranches. We should be going ready. As long as we are investing in bargains and assets, yeah, knowing what we buy is the most important advice that I would say when it comes to beginner or intermediate investors right now. Because if we know what we buy, for example, if you're in the fashion industry, you could make money from understanding the business, their seasonality, how they sell, whether or not they're doing the right things in marketing, what is their earnings growth for this company, what is the demand, etc. So this is essentially the most simple but hard, the only thing that people don't do is to know what you buy, why do you buy them, and how long are you going to hold them for, right? So at the end of the day, Nasdaq going down is driven by the average of all the companies' market values going down. So if companies' market values go down at the moment, which is 40% driven by market sentiment, which is exactly what's happening now, their fundamentals get better. Eventually, will their fundamentals get better even in 2 years' time or 3 years' time? And will their values appreciate from these fundamentals? That's the biggest question. That's why when it comes to investing, whether we like it or not, everything is backed by fundamentals. Now, you could be a trader, you could be an investor, you could be a fund manager having a quota and say, okay, fundamentals is not relative right now. People don't care about fundamentals, right? All the stocks are going down regardless. Google is getting punished. D&O in Malaysia is getting punished. Good fundamentals, who cares, right? Everything is going down. Yes, that's true. But what is the reason that you're going to be buying these assets? And end of the day, it points down to fundamentals. So know what you buy, know what sector you can thrive in, know why and understand why the market is actually going down in the first place, and maybe we can leverage off by capitalizing on these assets with a fundamental reason. Now, people talk about hedging this, hedging that, going to inflation, beneficiary stocks, going to commodities. But a total understanding of why, and especially if they have a longer term horizon, yeah, we should understand that commodities such as lithium, copper, silicon metal, that is very beneficial in the value chain, will have a fundamental reason to be lasting longer than other commodities. The reason, and especially where that's why fundamental reasons will have a backing of why coal shouldn't have a good place maybe in the next 10 years. But they're going up now because we are still dependent on fossil fuels. We are living in a world where technology is still dependent on them and is not clean all the way. But the fundamental reasons and should cushion you to push you forward, and this gives you a margin of safety, which is an element important in the stock market, to be knowing, okay, we should be buying at these times now because we are shifting to cleaner world, cleaner energy, clean energy. Yep. These beneficiaries of lithium, copper, silicon metal are beneficiaries of the EV market, right? Being very important in the value chain. So when that story kicks in, that's where their asset prices and asset values should demand a better valuation moving forward. Now, that's what I mean by fundamentals, okay? So know what you buy, why you buy, and how long you want to hold it for. If you identified that you're going to hold this bad boy for 5 years, then stick to it. Because the market sentiment is going to go down, yep. We might go into recession later, which in a year or a few months, I'll be addressing that later. But you are buying this simply because you understand this game. Yep. You think that they are undervalued right now versus X amount of years that you want to hold, and you have the cash to do so. Yep. So everything is interrelated. We need a good portfolio management. Yep. Either you want to hold 20% cash that you feel comfortable with, you understand your sector allocation, you understand whether or not you are a trader or investor, how many percent is allocated for short-term returns, long-term gains. This is all about portfolio management, which Academy preaches. Yeah. So essentially, this is what we need to understand: know what you buy and whatnot. Now, and the shorter-term bad news, or good news rather, is that wars may last to up to 146 days, which is similar to the Pearl Harbor case. Yeah, the Pearl Harbor attack was a major, huge, right? Quite a big scenario. And this might happen similar. So we have close to 6 months, right, of lowering down asset prices and another 6 months to recover to where it was. But again, if you understand your portfolios and if you have them right now, we should be piling on more and not be worried about market sentiment if the fundamentals are not affected with the Russia v Ukraine war, and just be going against the herd and just be owning more and more shares of your long-term winners. That's the game plan. Yeah. But let's talk about something a little deeper that might affect our portfolios, in a year to come. Yeah. So we know based on the market is always in cycles. Now we have been enjoying a 12 to 13 year bull run ever since the big crash in 2008. So the scenarios are that, how do we hedge? So the scenarios are that if, let's say, the market goes further into a recession, and that is driven by lower unemployment rates. So how it works is the unemployment rates right now is very low. Yep, it's at very low levels, okay, simply because it's driven by a rising economy. The reason why, even though Russia v Ukraine is actually still having a war and US can afford to raise interest rates, is because the economy is getting better, they can afford it, and they must combat inflation. So whatever that's happening in the world right now pressures more of interest rates to go up, pressuring more commodity prices to go up, and that's where I think we can actually have our money on to capitalize on these events. Now, we called out energy, we called out hibiscus, Rex, all these. You can gain like 20% in 2 weeks, and that's because of market sentiment. Oil prices are 126 right now per barrel, all these sort of things. But the bigger the bigger fear that we should be mindful of, in my opinion, is that we may be suffering a long bear market. Yeah. Now, the reason why is because unemployment, when it goes down, when the economy is getting better, they would have to raise interest rates. And when another indicator of whether or not recession is expected to come will be when interest rates, shorter term interest rates, are higher than the longer term interest rates. And that's where the yield curve inverts. When the yield curve inverts, a recession, as an indication that a recession will come. And that might happen in a year's time. So we've seen history where 2008, 2007, where the whole market is actually at tippity top, but the economy is actually getting worse after inflation actually kicks in. And, recession happens, that's where everything else goes down, and before recovery. Now that recession actually lasted for 1.5 years, 1 year. But after that, we might go into another huge bull run. So that's the macro perspective that might happen. And this is where we need to be really cautious. Yeah. So again, we need to know what's happening in the market right now, know what we are buying to combat, drawdowns, combat what's happening in the market, capitalizing off these gains, whether it's thematic. And that's where, in my opinion, we should be having a diversified portfolio of a 30-70. Now, if a recession happens, does that mean I'm going to be selling off my Teslas, my high growth stocks, those companies that I deem will have a fit in the years to come? No, I won't sell them. But that's where I have the luxury of actually the 30% to focus on shorter term gains and, capitalizing on inflation and capitalizing on beneficiaries that I understand why, commodity prices are going up. Shouldn't I be buying commodities ETFs and so on? Yeah. So understanding the fundamentals behind it is the reason why we should be investing to combat inflation and combat these drawdowns. Yeah. So I also want to talk about sector rotation, where we look at, and we talked about this before. So where do we think we are at in the position where the stock market is and the economy? So the red line indicates the stock market movement. The blue line indicates the economic movement. So markets are always in cycles, right? And it relates to interest rates, it relates to inflation, and it relates to where money flows overall. So we have enjoyed a 12 to 13 year bull run of, the stock market going up. So that's where the market bottom and bull market actually, thrives, right? And based on history, every bear market lasts for maximum 1.5 years. Every time there's a bear, the bull thrives further. So this is good news, right? Obviously. But where are we now in this cycle? So this is exactly what's playing out. When interest rates go up, when materials go up, we can expect basic materials go up, energy, staples to be the sectors that will thrive. So why staples? Because they are defensive stocks, and that's where money will flow to, because these are necessities for us to live on. Yeah, and energy, where prices will still go up, triggering yet another recession indicator. So we might be at the stock market at these levels. Yeah, so the Nasdaq already hit bear market. That indicates that what are the sectors that we should be putting our money on to be capitalizing? Energy, again, energy, staples, healthcare. Healthcare is another defensive sector. Yep. So the scenario is a little different because commodities is in play, right? And commodities relates to basic materials, energy as well, some industrials. But if we have our money onto commodities that have a fundamental reason for why they should be prolonging, and have a reason for their values to go up, we should be protected regardless of where the market goes. So if you're a long-term investor, right, we could be putting our money into staples or defensive stocks other than holding cash. Companies that give dividends is better than cash. Companies that have potential capital gains are better than cash. So cash is trash in a way, but cash is king if you know where to put your cash at. Cash is king right now, obviously. That's where, again, we did another video on this. In bad times, we should be preparing liquidity. assessing our personal liquidity, cashing out more so that we know where to deploy, but it doesn't work. Position of power doesn't work if we do not know where to deploy the cash. So cash is trash, right? Because holding it doesn't work. Cash is king. If you know you've got a bunch of cash now and you know where to deploy to be gaining 15% in the market when the market is actually overall down. Imagine if 2022 S&P 500 is down 10% and you gain 15%, you're essentially beating the S&P 500 by 25%. Yeah. So these are things to know. We're in a bear market, and again, this is not certain. We never know where we are, but these educated guess, sector rotation indicates where we are, what are the sectors we should be thriving on. We are not even at late bear market. We're not even at the bear market, essentially. I think we are at high above, and that's where we need to think about how do we protect our portfolios and so on. Yeah. So then again, in the bear market, during the 2008 bear market, which is probably maybe even the worst financial bear market in history, these are the stocks that essentially thrive. Now, these are the stocks that I actually shared as well during our course modules, right? We got Dollar Tree, and these are US stocks. Vertex Pharmaceuticals, right? Imagine owning a stock where the whole market is actually going down 50%, and your stock, that single stock, profits 60%, bringing you a 1 year 60% total return in that year. Isn't that amazing, right? So these are things that we should get ready, in my opinion. Yeah, over the longer game. We got H&R Block, Amgen, Walmart, right, Ross Stores, all these companies actually going up because they're necessities. And that's where money flow actually goes in when the whole market is going down. Yeah, so these are things to think about. But over the shorter run, which I can't predict. War, Russia v Ukraine war might, just stop, and for some reason Putin says he's not going to be buying he did this war because he wants to buy the dip, let's say, and let's say the war stops, prices are going to go back up. Stock prices are definitely going to go back up. But when the whole market goes back up and no longer in an environment where things will sustain because interest rates are still going up, banks are going to say, hey, it's time to raise interest rates again. And when they raise it again, stocks are definitely going to go back down. And, with everything, all the headwinds in place, we might go into a longer term recession. But end of the day, we still need to be understanding what is going up during that recession, right? What is the beneficiary? Because when things go down, something will go back up. And what is going back up will be commodities. Inflationary beneficiary stocks. When interest rate goes up, financials will be the ones to play. Yeah. So in my opinion, these are the stocks to be actually looking into, to be capitalizing and protecting our portfolios. So again, if you enjoyed this video, appreciate it if you guys can subscribe to our channel, like our video, and I'll see you guys in the next one. Thank you.